Welcome to StockTok's deep dive into Lumentum Holdings Inc. Lumentum designs and manufactures optical and photonic products used in telecommunications networks, data centers, and industrial applications. At the time of recording, the stock is trading at 894, sitting well above both its 50-day moving average of 703 and its 200-day moving average of 340. A technically extended setup by any institutional measure. The 52-week range runs from 49 to 960, placing the current price near the upper bound of that range. The RSI, or Relative Strength Index, a momentum indicator scaled from 0 to 100, sits at 61.9 neutral, but approaching elevated territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Lumentum generates the majority of its revenue from selling laser and optical components, products that sit at the heart of fiber optic communications infrastructure, and, increasingly, artificial intelligence data center build-outs. The company's competitive positioning rests on deep engineering expertise and long-standing customer relationships with major network equipment providers. Against that backdrop, the StockTok score comes in at 30 out of 100, a signal that warrants serious caution, in our view. Across the 5 dimensions, valuation scores 10 out of 20, financial health 14 out of 20, profitability just 4 out of 20, growth a troubling 0 out of 20, and smart money only 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio, that is, what the market pays for each dollar of historical earnings, stands at 274 times. That is an extraordinary multiple by any benchmark. The forward price-to-earnings ratio, which uses consensus earnings estimates for the year ahead, compresses to 59 times, still a significant premium. The EV/EBITDA multiple, which compares enterprise value to earnings before interest, taxes, depreciation, and amortization, and is widely used to compare companies across capital structures, registers at 204 times. The price-to-sales ratio sits at 32.8 times. These are not the multiples of a company priced for modest success. They embed a very aggressive growth recovery scenario. The Guru Focus Value, an independent intrinsic value estimate, is 78.98 at the time of recording, against a market price of 894. That implies a margin of safety, the discount to intrinsic value, of negative 1,032%, meaning in our view the stock trades at a dramatic premium to assessed fair value. Wall Street analysts at the time of recording have a consensus mean price target of 773 across 23 analysts, with a high of 1,225 and a low of 455. The current price already sits above the street's average target. In terms of competitive moat, the data suggests Lumentum benefits from meaningful switching costs and proprietary photonic technology, but those advantages must be weighed against the price being asked. The next earnings report is due on the 5th of May, 2026, with the street expecting earnings per share of approximately 2.26, a near-term catalyst worth monitoring. Market sentiment around Lumentum, as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the balance either way. In our view, the valuation setup is stretched. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency, comes in at 6 out of 9. That is a respectable mid-range reading, not a distress signal, but not a pristine balance sheet either. The Altman Z-score, a model originally developed to predict bankruptcy risk, registers at 9.46. Any reading above 3 is generally considered safe, so on that metric Lumentum appears financially stable in the near term. However, the credit picture becomes more nuanced when we look deeper. Cash to debt is 0.35. Meaning the company holds 35 cents of cash for every dollar of debt outstanding, a relatively thin liquidity cushion. Interest coverage, which tells us how many times operating income can service interest expense, is only 0.45 times. That is a critical data point. The company is currently not generating enough operating income to cover its interest payments, which warrants caution in our view. The current ratio, current assets divided by current liabilities, is 0.61, meaning short-term liabilities exceed short-term assets. Finally, debt to equity stands at 3.93, indicating the balance sheet is substantially leveraged. The verdict on financial health. The Altman Z-score provides comfort on solvency, but the interest coverage and liquidity ratios reveal genuine near-term financial constraints that a prudent analyst cannot overlook. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, the return the company generates on every dollar of capital deployed into the business. At 0.29%, it is effectively negligible. For context, a business creating genuine shareholder value typically needs return on invested capital to exceed its cost of capital, which for a technology hardware company tends to run well into the double digits. This is one of the weakest readings across the entire scorecard. Moving down the margin stack, gross margin, the percentage of revenue left after direct production costs, sits at 33%. That is a workable foundation for a hardware manufacturer, though not exceptional by photonics industry standards. The problem emerges lower in the income statement. Operating margin, which captures the efficiency of the core business after overhead and research costs, is a razor-thin 0.49%, essentially break-even at the operating level. Net margin improves to approximately 12%, but that improvement is largely a function of below-the-line items rather than operational strength, which limits its quality in our view. Most concerning is the free cash flow margin of negative 1.4%, meaning the company is consuming cash rather than generating it. Free cash flow, the cash left after capital expenditures, is the lifeblood of any business, and a negative reading here reinforces the profitability concerns the scorecard already flags. On to growth. Is this business expanding, and at what rate? This is where the data becomes most difficult to reconcile with the current valuation. Over the trailing 3 years, revenue growth has averaged negative 1.3% annually. Contraction, not expansion. Extending the window to 5 years, the compound revenue growth rate improves only marginally to 0.8%. In the context of a technology hardware company operating in what the market narrative frames as a high-growth AI infrastructure cycle, a sub-1% 5-year revenue growth rate is a striking disconnect from the premium valuation the market is assigning. The growth dimension receives a score of 0 out of 20 on the StockTok scorecard, the lowest possible reading. Book value per share, which reflects the accounting net worth attributable to shareholders, has declined by 16.1% over the trailing 3 years. That is a meaningful erosion of the equity base, driven by a combination of net losses in prior periods, share-based dilution, and debt. Lumentum pays no dividend, so there is no yield component to compensate investors for waiting out a recovery. The growth thesis, and the current market price appears to embed a very optimistic one, requires a sharp inflection in revenue and earnings that the historical trajectory has not yet validated. We would want to see multiple consecutive quarters of accelerating top-line growth before the narrative aligns with the numbers, in our view. Now let's talk smart money. What institutional capital is actually doing with this name? On the surface, 7 top-tier guru investors currently hold a position in Lumentum. That is a non-trivial number of high-conviction institutional managers with exposure to the company. However, the smart money dimension scores only 2 out of 20 on the StockTok scorecard, and when we look beneath the headline holder count, the underlying signals are decidedly cautious. Insider ownership stands at 1.59%, a low figure that suggests management has limited financial skin in the game relative to the size of the enterprise. In terms of recent insider activity over the trailing 3 months, the recorded transactions show 0 purchases and 6 sales by insiders. Insider selling alone is not conclusive. Executives sell for many reasons, including tax planning and portfolio diversification. But a pattern of 6 sells and 0 buys, combined with low baseline ownership, is a signal that a rigorous fund manager cannot dismiss without explanation. Turning to the broader institutional picture, only 5.2% of the 13F filers, the institutional investors required to disclose holdings to the Securities and Exchange Commission, are classified as net buyers. A reading above 50% would suggest broad institutional accumulation. At 5.2%, the data suggests the vast majority of institutional capital is either holding steady or reducing exposure. The smart money picture, taken as a whole, does not corroborate the bullish narrative that the current price implies, in our view. And finally, the verdict. Let's bring it all together. On valuation, the data suggests Lumentum is priced for near perfection, a trailing price-to-earnings of 274 times, trading more than 1,000% above the Guru Focus intrinsic value estimate, and already above the Wall Street consensus mean target. On financial strength, the Altman Z-score provides near-term solvency comfort, but interest coverage of less than 1 times and a current ratio below 1.0 are genuine structural constraints that the balance sheet has not yet resolved. On profitability, return on invested capital is effectively zero, free cash flow is negative, and operating margins are barely positive, a combination that does not justify a premium multiple in our view. On growth, revenue has declined over 3 years and grown at less than 1% over 5, with book value eroding sharply. The growth thesis is aspirational at this stage, not empirically supported. On smart money, Guru ownership provides some comfort, but insider selling, near zero insider ownership, and minimal net institutional buying create a cautious overlay. The overall setup, based on what we see in the publicly available data, warrants significant caution. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Lumentum Holdings Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.